Hi everyone, I hope you're enjoying the snow. And I figured that what I would do today with you is go through example 3 that I posted online. So this is where you go from having a financial instrument, then you do a deemed disposition, and you have to switch over and start using equity method. So you have the problem, it's posted on the group, and I wanted to walk through the solution again because I think that some of you were just a little confused. And I also mentioned something about how you need to prorate the income when you use equity method, whatever. So how about we go through the problem, and this way it'll really clarify it for you, and you can use this video as reference. So our example 3. So we have this company X that acquires company Y, and they acquire 10% of it for $10,000 at January 1st, 2016. Okay, now the problem tells you afterwards at December 31st, they give you all this information. Y has income of so-and-so, dividends of so-and-so, and then it has a fair value of so-and-so. Then it talks about March 31st, 2017. So hold on, let's draw out a timeline. So on our timeline, we have January 1st, 2016. This is when they acquire 10%, okay? Then we hit the December 31st, 2016 year end. So this is when you book any year-end entries that you have. And now the problem starts talking about March 31st, 2017. So if you draw out the year 2017, somewhere over here at March 31st, 2017, 3 months into that year, they acquire an additional 15%. So basically, hopefully you can already see what's going on here, but what's happening is that here you have a financial instrument and you're going to use the fair value method, and we'll say fair value through profit and loss, to book your entry. So you're going to book your initial acquisition here. Here you're going to report any dividend revenue that you earned and any gains or losses on the fair value of the investment. Then we're going to do a little bit of accounting here to make up for this 3-month difference. And what you have to do here, here's the most important part. At March 31st, 2017, you have to do something that we call a deemed disposition. So what does this mean? This means that at March 31st, 2017, if you had 10% and now you buy this additional 15%, you no longer hold a financial instrument, right? Because you now are going to own 10 plus 15, which is 25%. So now you're going to hold, now you're actually going to be you're going to hold an associate, right? So now you have to report under equity method. So for you to go from here to here, what we have to do is we have to dispose of the 10% we previously owned, and then we have to reacquire the full 25%. So I'll show you how to do this, okay? So let's start very simply. So we know at January 1st, they acquire this, it's $10,000. So let's book the acquisition entry, okay? So at January 1st, 2016, you have your investment that you're acquiring. So you have debit, investment in company Y, and you paid cash. So that's debit 10,000, credit 10,000. Then what happens is at the year end, okay, they're telling you, and let's write it out, at year end, at December 31st, 2016, they're telling you that Y has income of 30,000, pays dividends of 10,000, and has a fair value of 110,000. Okay? Now what you need to use, okay, is the dividend and the fair value. Because remember, the entry that you book at year end is twofold. You're booking one entry to book the dividend revenue. You're booking the second entry to book any gains or losses on the fair value of the investment, okay? This, you'll see, we're gonna use it later, okay? But they're giving this to trick you. You don't need to use it. You only need these two right now. Remember, we're using fair value through profit and loss. That's what we're using this entire time. Fair value through profit and loss, okay? Because it's under 20%. So let's book the entry. Now you own 10% of B, right? So you're going to claim 10% of the dividends, which is $1,000. And actually, yeah, let's go and book that one. So you're going to get cash for $1,000 on the dividend. And that means you're going to make dividend revenue of $1,000. Now, how do you know if you made any gains or losses on the investment? Very simple. You take your fair value. You have 10% of this. So the fair value of your 10% is 110 times 10%, which is 11,000. You previously had 10,000. That's what you acquired it at. So 10,000. The difference is 1,000. It went up by 1,000. That's your gain. So your gain, you're going to book that. You're going to make the investment go up. So you're going to debit investment in Y because your investment went up by $1,000, and you're going to book a gain because your gain is, you can also say gain net income or gain fair value through P&L, whichever one you want. But basically it's fair value through profit and loss. So it's going to go through income, and that gain is the $1,000. That's the credit side of your entry. Okay. So this basically, you did the entry here. Now you did the entry here. Now this is the difficult part. What are you going to do in these 3 months? Okay. Now just listen to the theory. In these 3 months, there's going to be some kind of profit and loss, okay, that's recorded. So you have to record that 3 months under the fair value through profit and loss. And then you have to dispose of it, and then you have to start using equity, okay? So here you're using fair value through P&L from here to December. And then from December until March 31st, you're still under fair value through P&L. And then you dispose, you reacquire, and then you use equity. Okay, so let's go through the math, and hopefully you will catch on to what is happening. So just going to get rid of this, and let's look at March 31st, 2017. So at March 31st, 2017, okay, and this is key. They're telling you X purchases an additional 15% of Y for $21,000, and you have nothing else. So here's what it is. You just have to dig into this. It's all you need. There's 15% of Y purchased for $21,000. So here's what I tell myself. I really like to go in baby steps, okay? 15% of Y is fair valued at $21,000, right? And you need to dispose of your 10%. But what is the fair value of that 10%? Here's how you're going to find out. If 15% is 21,000, okay, 15% of Y is 21,000, then 100% of Y is going to be this. It's simple math. You just got to do 21,000 divided by 0.15, right? So if you do 21,000 divided by 0.15, your full 100% is 140,000, okay? But you're getting rid of the 10% in Y. That's the percent that you had before, that you initially had, okay? So you're getting rid of that 10%, which is at March 31st, 2017, your 10% is worth 140,000, right? If 100% is worth 140K, then 10% is worth 14K. Right? You just got to do 140 times 10%, 14K. So let's go back over here. So at March, let's write it out, okay? Let's really break it down. Here, your investment was 10,000, okay? Here, you booked the gain. You booked this gain over here of $1,000. So now your investment is 11,000. And now we just did the math, right? We had to account for this gap. You can't just forget about this gap. Your fair value between here and here is making some kind of loss or profit. So now it's at 14,000, right? And you're going to dispose of it. So when you dispose of it, here's what you're going to do. You're going to get rid of it. So let's get rid of it first. Your investment in Y, okay? And you're getting cash for it. So if it's valued at 14,000, they're going to give you 14,000 for it. They're not going to give you any more, right? That's what it's worth right now at March 31st. So you're getting cash of 14,000. Debit. Your investment in Y was on your books at 11. Okay, that's what it was last on your books at. If you take a look at your balance sheet, if we put out our balance sheet, okay, and you have this item called investment in Y, it was at 10, then you booked 1,000 to it, it's at 11, right? That's what it's sitting on at your balance sheet. So to get rid of it, you have to credit 11 because that item is going to leave your balance sheet now. You're disposing of it, or you're deemed disposing of it, right? It's the same thing. So you're crediting 11,000, I'm sorry, 11,000 to get rid of it on your balance sheet. The difference is your gain. So is your gain, the difference is, let me just double check this. It's 14,000, 11,000. Yes. So the difference is your gain, right? You're going to credit a gain of 3,000 in that 3 months. In these 3 months that passed by, your investment made a gain of 3,000. Okay. So that's what you got to book. You just have to reflect that gain. Because now your entry balances. You have 14 on this side, 14 on this side. Okay? Now that you've done that, now that you booked this entry, what you're going to go back and do is you're going to now acquire the 25%. Okay? If you see if you understand what's going on here, basically, you're getting rid of the 10%, right? Under fair value through profit and loss, and you dispose of it, and you reacquire what you previously owned, the 10, and what you're picking up, the new portion that you're picking up, which is 15. So 10 plus 15, 25%. So let's go back up here. Simple math again. If 100% is worth 140,000, then your 25% is going to be worth 35,000. That's what your 25% is worth at March 31st, 2017, right? Because you got rid of the 10%, but you're reacquiring the 10 and the 15, so 25, okay? So let's book the entry. So now we are using equity method. Remember, oh no, my pen ran out. This is a bad time. So now we are using equity method. Because remember, equity is when you own 20 to 50%. And that's where we fall. We now own 25%. So you're going to debit your investment in associate, 35,000, and you paid cash of 35,000. Now, let me just take a moment here. There are some of you who are in Sophie's class and you are booking it as one entry. You don't need to separate the entry. If that is how you were recording it with her, then you can use that method, because in the end, the net effect on cash should be the same. So if that's how Sophie is teaching you and you prefer to use that method, it's 100% valid, okay? This is just how I am used to doing it, how I was taught to do it, and so I like to go with this method. So back on track. You booked your 25% stake, okay? That's done. Now, don't forget, you have one last entry to book, okay? Now you're at December 31st, 2017. You own 25%, okay? And now you're using equity method. So under equity method, we have to pick up our share of income. So here's how we're going to do it. So in 2017, at December 31st, 2017, and this entry up here is March 31st, 2017. So at December 31st, 2017, the question tells you that, what does the question tell you? The question tells you that Y has income of 40,000, pays dividends of $15,000 and has a fair value of $160,000. Now, under equity method, when we pick up our share of income, we no longer care about the fair value, okay? This is why I told you. When we did it over here, when we did it the first time, I said we care about this guy and this guy under fair value through profit and loss. But under equity, we care about this guy and this guy. This under equity, we don't need it, okay? So if you're gonna book your income, you're gonna pick up 25% on your share of income, okay? That 25% on your share of income is going to be, let me just grab a calculator. That 25%, this is a great time to lose your calculator, huh? There we go, okay. So if we take your $40,000 times 25% is 10,000, okay? Now be careful. It is 10,000, but you only acquired it in March. That's 3 months into the year. So you were only entitled to 9 out of 12 months of the income of company Y. So be very careful. This is what I meant. You have to prorate the income when you switch over in the middle of the year. So 10,000 times 9 over 12, you're going to get 7,500. That's your share of income, okay? Now your dividends, you pick up 25%. That's going to be 3,750. And you don't prorate the dividend. That's the difference. For income, you're only entitled to your share of the income over the months that you held the investment, right? So that's why you have to prorate it for income. But for dividends, you don't prorate. You are entitled to the full share of your dividends, regardless, okay, of when. So now let's just book the entry. This is the final entry that we have to book. So to book the share of income from company Y, you're going to debit your investment in associate. That's 7,005, and you're going to credit share of income 7,005. And finally, for the dividend, you're going to book debit cash, and you're going to do credit share of income. Oh, I'm sorry. That's my mistake. You're not going to credit share of income. For this one, for the dividend under equity method, you're just going to credit investment. Investment in associate. 3,750, 3,750. So that is how you do the entries for this example. I will post the Excel solution to it. So you'll get a solution, but I just wanted to go through it to make sure you understood it because I felt like some of you were just confused as to what was going on. So to recap, let's use some colors to recap. Here, you're going to use fair value through P&L, right? Because it's under 20%. It's a financial instrument, and we're using fair value through profit and loss. Here, we're still using fair value through profit and loss because those 3 months we have to account for. At this point, we do a deemed disposition, and then we continue here and we use equity method, okay? Because we got rid of the 10% under deemed disposition and we reacquired our 10% and 15% share to have 25%, which is reported under equity method. So I hope that this was useful to you, and that's it. So good luck with this question.